Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major Real Estate Podcast. I'm your host, Nathan Sosa, and this is my co-host, Matt Hamilton. Matt, whenever we start getting into the summer, normally at this point, I'm like, holy cow, it's just been unbelievably and unbearably hot. But actually, I was just thinking about this, is that we've actually had, and I guess that's the entire country. I didn't realize it wasn't, but it's the entire country that's kind of had a lot of rain and a lot of like nice cooler weather. Like honestly, the fact that Oklahoma was getting like 65 degrees mornings in the past month, it's very impressive, right? So like we're actually starting to get these unbearably hot days in July, but it's July, right? Normally it's like we're looking at like 90 degrees to 100 degrees to start the day. Do you feel the same way up in Missouri?
I mean, it's definitely cooler, but it's also like really humid. To be honest, I haven't really went outside too much in the last week or so. I was outside a lot last week, and over the weekend just had a lot of like indoor projects that I had to get done, and haven't really been outside too much. But it's been cooler, but definitely more humid. So yeah. It's kind of a trade-off.
You know, this is actually something that I've been wanting to talk to you about that I really feel like super important. So anyone who's watching on video, you'll see that I've got this Brahms mug here, right? Brahms is a staple of the South, in my opinion. It's an Oklahoma-based company, ice cream, fast food. It's essentially what Midwest folk would call Culver's. And so that's kind of the distinction I want to ask is Missouri the Midwest or is Missouri the South?
Yeah, that's an interesting question. So to clarify, I'm from the St. Louis area. I'm technically right on the Illinois side of the river. In Illinois, firmly Midwest. And I would say the entire St. Louis region of Missouri, I would say is firmly Midwest.
Hold on a second. Okay, so actually I want to take two steps back. So Missouri has two major cities that it shares with another state. Is that like I guess I didn't realize that. I knew that about Kansas City. It's the same way with St. Louis?
So all of St. Louis City and like St. Louis County and like the actual city is contained within Missouri. But the St. Louis Metro spans out into St. Clair County in Illinois and St. Louis County in Missouri on the west. So it's like the city is like right on the river. It's like right on the border. And
so basically, you're letting the other states just like take these cities from you. It's essentially what's happening. It's like you're letting Illinois and Kansas. You don't even have your own cities, right? I guess we can call Springfield. We can classify Springfield as a large city. Many of our coworkers who live in Springfield, but wow, that's kind of crazy.
Yeah, I mean, for what it's worth, I would classify myself as an Illinoisian, not a Missourian. So I am partaking in the taking. So no skin off my back. But okay. I would say, Springfield and Columbia, definitely 100% Missouri. They can keep those.
So hot take, Missouri, Kansas, and Colorado are all Midwestern states, in my opinion. Colorado, absolutely.
Midwest?
East Colorado is just West Kansas. That's the only thing.
Are we talking geographically or culturally?
Both.
Okay, Colorado is not. There's no chance Colorado is geographically part of the Midwest. Not a chance.
Have you seen the Eastern Colorado?
I mean, not personally. I'm just saying, like, just looking at a map. It's like I would say it's in the mountainous west. I don't know. I guess it's not West Coast, but it's like.
Have you seen how flat it is?
I would put like the Rockies as almost like their own category. It's not the Midwest. I feel like Midwest is like.
Well, see, that's a cutoff. That's a cutoff. Basically, if you look at how much the Rockies covers Colorado, it's really like a third. The other 2/3 is just plain land. It's the exact same as Kansas. If you drive through Kansas, you'll never know that you're like all of a sudden you cross Colorado border and you don't realize you're in Colorado any longer. You're now in Colorado. I mean,
is Wyoming the Midwest?
Definitely. I just pissed off a lot of Wyoming people, I'm pretty sure. But now that we've had this wonderful geographic take, that's gone much longer than I thought it would. Today's topic is going to be talking about preferred returns in syndications. And we're going to go through the basics, how they're structured, and how they're treated for tax purposes, because there's actually some disparity between the two treatments, and there's a lot of misunderstanding of how some of these get treated. Matt, I know you deal a lot with preferred returns. I know you deal a lot with what's going on there. If you had to explain preferred returns in a couple sentences, how would you do that?
I could probably do it in one. A preferred return is the amount of cash that an LP is entitled to above and beyond their return of capital.
If you had to explain it to a golden retriever, how would you do that?
So explaining it to a golden retriever, let's see. So very simply, it works kind of like an interest rate, where when you invest into a partnership, you do an initial contribution, let's say it's $100,000. Typically, in order to entice investors to invest in their syndication, the operator or the GP will put into the operating agreement a specific percentage rate of return. This could be 5, 8, 10, 20, really whatever you want, whatever you feel is appropriate to attract investors, but also possible to achieve. And there's an outline of how that's paid, but it's very simply just whatever that percentage return is on your initial investment. So if you're paid a 10% PREF every year, you invest $100,000, you're entitled to $10,000 a year. And if it's not paid, usually it's accrued and has to be paid out at the end. Generally speaking, you have to be made whole depending on the amount of cash available in the partnership and the cash waterfall that we kind of chatted about a couple weeks ago. But that was probably over the head of a golden retriever. But it a little more broken.
If your grandma understood, then you're good. So that's always the goal with these explanations. Is that like so long as grandma can understand, then we're golden. But I'm sure everyone listening was definitely okay with the first one. So I guess how many deals in operation do you wind up seeing that I guess the better question is not how many have PREF returns in them, how many don't have PREF returns in them? Almost
none. And the reason is because all these syndicators are competing for a finite pool of private capital. And if all of your competition is offering a preferred return, you're not really going to find many willing investors if you don't also have a competitive preferred return built into the investment. So it's just a way of sort of creating a floor for the investors whenever they invest in the fund. Now, obviously, you as the operator have to operate the property in such a way that creates enough profit and cash flow to actually pay that preferred return. But that's why it's so common. It's really, you're dead to rights if you don't really have one. It's going to be really difficult to raise capital unless the asset you've acquired is just so pristine that people want in on it just for the appreciation in the asset.
Right. Yeah. So it sounds like, like you said, is like outside of very small deals, probably everyone's getting some kind of PREF equity. Yeah. Now, I guess that bears the question then is when it comes to PREF equity in like these waterfall models, do you know when these started coming into play? Do you know how long these have been in play? Has it been like a past 50 years thing, past 20 years thing?
I couldn't tell you how far back it goes. All I can say is that I've seen them throughout my entire career, going back for, whenever I've looked at operating agreements from before I started. I mean, this at least been going on for a decade, 15 years. I imagine it's probably been going on for as long as these syndications and private equity deals have existed, just as a means of enticing investors, just as a simple means of making the investment more attractive on its face.
Yeah, no, absolutely. So I guess the PREF equity isn't for everybody, right? Actually, as strange as this sounds, I've always tried to think about preferred equity as like the partnership version of preferred stock, right? So like that's like the way to think about that. Is that right? Like there are probably Apple or NVIDIA shareholders out there that are getting very special preferred stock classifications, and they're going to get different payouts versus everybody else who owns the normal class of stock. So same thing when it comes to this preferred equity and these preferred returns that exist, right? And so, Matt, not every single investor in a syndication is going to have this PREF equity. Is that correct?
Yeah, that's absolutely correct. Oftentimes what you'll see, especially with bigger deals, is multiple classes of ownership. Obviously, there's always going to be the GP class, but ignoring them for right now, you'll usually see at least two classes of LP ownership interest. Could call them A, B, C, X, Y, Z. You can call them whatever you want, quite frankly. But we most commonly see class A, B, and C. Mm-hmm. And generally speaking, there's one class of LP that has the preferred return, and there's another class that doesn't. And why this matters is the preferred return increases the floor of the investment, but it lowers the ceiling. So usually what happens is those preferred, I'll call them preferred LPs that are receiving that preferred return, they're entitled to more cash flow throughout the life of the partnership, and they're entitled to more guaranteed cash flow at the end of the deal, assuming there's cash in the partnership. But after that, the other partners can participate in a less limited, there's less limitations on the upside that they get to share in. So if the property does super well, there's a ton of appreciation, you sell it for a huge gain, the return that those preferred LPs are receiving is ultimately capped by their preferred return, whereas those other LPs, it's less limited. If there's a huge gain, they get to share in that upside as a means of taking on that additional risk of not receiving that preferred return.
Nice. Okay. So I liked how you put that. It was that like preferred returns, you have a higher floor, but not as high of a ceiling. But then for the LP, like let's say, let's just call it the B and C units, you've got a much lower floor potentially, but you have a much higher ceiling because you're going to get the upside. That's actually, I really like hearing how you put that. That clicks a couple things for me too. And so that's how it all works on the business side from syndication perspective. What about taxes? How do preferred returns work for taxes, right? That's why everyone's here today. I want to understand how this works from a tax perspective. So a lot of people talk about that preferred returns are guaranteed payments, and that so there needs to be, so they're subject to self-employment tax, and that people become concerned hearing that they're going to have an additional 15% associated on top of whatever their preferred return is. That eats a lot into their capital and what their investment is and changes a lot of the calculus to that. So how do these work? Are they all guaranteed payments?
So that's a great question. Short answer is no. They're not all guaranteed payment. And to take a step back, what even is a guaranteed payment? A guaranteed payment is a payment that a partnership makes to one of its partners that, and this might sound kind of simple, but is guaranteed. And one of the most common ways you see that is, let's just say a professional services firm. Let's say it's a law firm, CPA firm, and there's partners that own the partnership. Throughout the year, they're paid a sort of minimum salary, and that is paid out via a guaranteed payment for services because they are rendering services to the partnership effectively as an employee, but you can't pay a W-2 salary to your partners. So you have to go the guaranteed payment route. So even if the partnership loses a ton of money and they flounder and don't make anything, those partners are still entitled to a payment for services. And that's what makes it guaranteed. They're paid that regardless of whether or not the partnership does well. Same thing applies for a guaranteed payment for capital. That's the other classification. So if you're a partner and you contribute X amount of dollars with the understanding that you are going to receive a specified return, regardless of how the partnership performs, that makes it a guaranteed payment for capital. And that last component there is critical because most of these preferred returns are not guaranteed in the sense that they're going to be paid out regardless of the partnership's performance. If the partnership loses a ton of money, has negative cash flow, and they have no means of actually paying this PREF, they don't have to go out and borrow money to pay this PREF. That's not what the operating agreement is intending. So in that sense, it's not guaranteed. So it's just a normal distribution in that sense.
Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. Okay, that's a pretty large distinction. And actually on the guaranteed payment piece, at some point we'll be doing an episode regarding the Soroban and Denham capital management cases because it actually is very applicable to syndications, not just real estate, but just hedge funds in general, and how these people are paid out and their legal structuring and how it's actually not working out for them. But we'll talk about that different day. Actually, Matt, so I want to, maybe it's a rabbit trail, but are management fees going to be considered guaranteed payments? Is that the same thing? Or is that different?
Depends on how you structure them. If they're paid out in a way that's guaranteed for the services that you perform, then yeah, they would be guaranteed payments for services. But they'll only show up on a K1 as a guaranteed payment if the GP entity, if an actual partner in the partnership is rendering the services. So oftentimes what we see is a separate operating S-Corp that isn't directly the GP. It's just a separate property management entity that you as the GP also own. In that case, it wouldn't be a guaranteed payment because guaranteed payments can only be paid to partners in the partnership. So if it's a related party, but not a partner, it's not a guaranteed payment.
Yeah, there's a lot of rules. A lot of people try to do a lot of things and get creative with that, right? So create like a layer entity in between. So then that pays the other partner in W-2 for the management fees, et cetera, right? It's a lot of, you can get creative with it. Just make sure you do it right. Because if you don't, that can create issues or just put you at risk. So going back to our preferred returns, right? I actually think it's a really interesting distinction is the fact to say, look, what matters is, I guess, one of two things, right? So basically, is percentage going to happen regardless of the performance of the fund, right? So basically, this is your guaranteed payment that you're getting by making this investment. But if it's related to, right, like if it's tied to a certain percentage, 6, 8, 10% of the performance of the fund, that's no longer a guaranteed payment. Now it's basically like, hey, if we make $0, guess what? You get 0 PREF, right? So that's a really important distinction, I think. How often do you see PREFs that wind up being guaranteed payments? Is that pretty frequent or is it pretty rare?
It's very infrequent. Usually the boilerplate language you see in the because this is kind of determined by the operating distribution section of the operating agreement. Because it'll describe a PREF that needs to be paid, but throughout the life of the partnership, it almost always says at the discretion of the manager or when the manager deems it possible and necessary to distribute those preferred returns. Sometimes you might even see a specific, I'll say, quantitative limitation where it says, well, these will only be distributed if the fund itself hits an internal rate of return of X%. And if it hits that, then we can distribute that. But ultimately, it's up to the manager to determine what that internal rate of return is. So it's just kind of, it's a different way of saying the same thing, but you have to show your work and say, like, this is why we came to this determination. But regardless, I think there's been like 1 or 2 funds I've seen that have actually had guaranteed payments. And in both of those scenarios, the partner that had those guaranteed payments, they're understanding that this was functionally more of a loan than a contribution. And in that scenario, your upside is even more limited than just the regular preferred return. It really is limited to almost like those, I'll call them quasi-interest payments, where you're receiving those guaranteed payments for capital.
That's interesting. So what are some other examples that you've seen where it was a guaranteed payment, or have you seen any others?
That's the most common one I've seen. I've only seen it a handful because it's a handful of times. It's super uncommon. But in each of those scenarios, that's the similar story where the LPs, it's usually someone that very cash heavy and they're making these large investments, and it's able to make the partnership, it reduces the amount of capital you have to raise because it's usually people coming in with more cash, but it puts the operator in the operation of the partnership in more risk because now you have to pay that preferred return back because it's guaranteed now. It's not just contingent on how well you do. You have to do well enough to pay that preferred return. So it kind of changes the dynamics of the operation.
Yeah, it definitely does. That's super interesting. How the fact that you don't ever see it as a guaranteed payment, because I really feel like that people think preferred returns should be considered to be guaranteed payments, just like on the outside looking in. But then you look into the nuts and bolts of it, it's not the case, and it's almost never the case. And this is what it sounds like to me, at least from your experience. So that's really interesting. It's a very interesting note to think about. So when you have a preferred return, so this is something that's actually just came up for a client of mine recently. When you see these preferred returns, they sometimes get attached to capital calls, right? So a lot of times, if a fund isn't not necessarily not performing, but it's maybe in a time frame where it needs a cash influx, it'll do a capital call. And so actually first, what is a capital call? When do you see funds want or need to have a capital call? And then do you normally see them issue PREF returns in those instances?
That is an excellent question with a lot of layers to it.
Yeah.
So just at a high level, a capital call is when you have a syndication or a fund that owns property and you've already done the capital raise. There's a handful of partners or lots of partners that have an equity position in the partnership. And for whatever reason, the partnership is running into cash flow issues. And at that point, you have a couple options. You can go to a bank and you can try to get financing to get more cash, or you can go to your existing partners and either request or demand, because sometimes you can put it in the operating agreement stating that they have to participate in a capital call. You can either request or demand that they contribute X amount more capital. So let's say you need 10 million more dollars. You can take 10 million, multiply it out by, the pro rata shares of each of the LPs and request that they make that additional contribution. This has become increasingly common. And why is that? Well, years ago, when interest rates were super low, the cheaper route was to always borrow cash from the bank, because if you're paying a preferred return to your partners, it's probably at least like 10% typically. But if you can go to a bank and get cash for, 3-4%, then it's a no-brainer. You go that way. But over the last 3-4 years, it's been increasingly common to see capital calls because it's cheaper ultimately to go and request additional funds from your partners than it is to go to a bank. Or sometimes bank financing just isn't possible for whatever reason. It's also worth noting that a lot of real estate operators over the last couple of years, especially with inflation and a lot of increasing prices across the board, have been running into a lot of cash flow issues. And I have seen on my end these capital calls become increasingly common across all of my clients, across multiple sectors, across different asset classes. It's really a pervasive issue that a lot of syndicators are running into right now.
Yeah, unfortunately, we're seeing more and more. Do you think this is happening because, we had a bunch of, I don't want to say first-time investors, but definitely some early syndicators. They got a lot of bridge loans and got a lot of variable interest rates that now it's five. So we're 2020, 2021 would be the 3 to 5 year window for those loans, and now they're coming due. And so is that kind of what you've seen in your experience? Is that that's the reason why now they're going to have an interest rate they can't handle any longer?
Oh yeah, 100%. In the early 2020s, late teens, when interest rates were super low, there were a ton of new people getting into the syndication space because they were either influenced or convinced that it was super easy. Interest rates are super low and real estate's always going up. Nothing can go wrong. There were a lot of people, drinking the Kool-Aid and like, oh man, I can do this. And just anecdotally, I've been at Hall for about 3 years now. And even then, when I was first here, there were a ton of people, a lot of clients we had in the syndication space who were very new to the syndication space, and they only had a handful of funds. But just in the people that we've worked with over the last 3 years, a lot of those people have kind of sputtered out because things have gotten substantially more difficult. There are higher cash requirements, higher interest rates, crushing downward pressure from prices. There's a lot of factors that sort of drove a lot of these syndications and funds to be unprofitable. It just kind of forced a lot of those newer folks out of the space.
Dang. Okay. That's super intriguing how that's happening there. Yeah. Hopefully, it's unfortunately we keep seeing this, like you mentioned, where a lot of people are having to, and we'll probably do the episode on when investors can take those losses and how that works, and when you can declare basically is hey, this is a bad investment. When can I take the tax loss, right? Because they can help you save 30% on the overall loss, right? It's we don't want to have losses, right? Because it's not great from an investment standpoint, but sometimes can help us from a tax perspective to either offset other income or just help basically save 30% on that lost transaction. So at least get a little bit back, at least from the government or from that perspective. So Matt, what about capital accounts? How do PREF returns play into capital accounts, or is it just kind of same old, same old?
This is a question that I get all the time, and it usually really surprises clients to hear the answer. But they ask, whenever a partner invests in the partnership, they have a capital account. Easy math, let's say they invest $100,000. Their capital account is $100,000. And they receive a preferred return of 10%. So they're distributed $10,000 of cash. How does that impact their capital account as opposed to receiving, say, a $10,000 return on investment? And the answer is it's treated identically from a tax perspective. Both are treated as a $10,000 distribution that pushes your capital account down by $10,000. Where this will come into play is later on, as we've probably talked about on almost every single episode. At the end of the day, your capital account in the partnership has to go to zero. And let's say that you have a $100,000 investment and you receive a 10% preferred return every year for 10 years, and you're distributed $10,000 every year. And for easy math, there's no income or loss allocations for whatever reason. Not realistic, but just sort of an illustrative point. So over 10 years, your capital account is reduced down to zero by those distributions, but you're still owed a $100,000 return of capital whenever this all wraps up. So you're going to be distributed $100,000 more dollars. And in that scenario, you would have to pick up $100,000 of income to get your capital account back up to zero. So ultimately, at the end of the day, it becomes a timing issue because over the course of that entire life of the partnership, you were allocated $100,000 of income and you received $200,000 of cash on your $100,000 investment. So you're picking up income exactly equal to the amount of cash that you put in or the additional amount of cash you pulled out. It's just a timing issue. And that's kind of how I explain this to clients is on its face, those distributions are treated exactly the same. But over the course of time, they're going to have to pick up income equal to the amount of cash that they pull out of the partnership in excess of what they put in. And that's just how they're made whole over the course of the entire life of the partnership.
Interesting. Yeah. So you can't escape tax, man. Right. As always, like there are ways we can strategize around that. But basically, it sounds to me that like, look, there might be a common event if you're dealing with preferred returns that you have phantom income. I mean, that's not fun. It's not a great place to be, but it does happen. And like I said, we can work around it, but there's definitely opportunities, situations where it might occur. So I appreciate that, Matt. That's a really good walkthrough. Anything else you can think of on pref returns, or we pretty much beat up the topic, at least for today?
I think we've pretty much covered it. The only other thing is how this kind of falls into the cash waterfall. And this is just one kind of final note on different types of prefs. Some prefs are accrued, some are not. And you can kind of write that either way. So if there's an accrued pref and you don't pay anyone their preferred returns for years, you have to pay the entire cumulative balance of those unpaid preferred returns at the end of the partnership. Whereas if they're unaccrued, you might not have to do that. So there's different nuances in the ways that you can kind of structure these preferred returns. And it's really important to speak to your CPA and your attorney to understand the way that you're writing the language in the operating agreement to make sure that it's accurately reflecting the economics of what you're trying to achieve through those preferred returns. And that's important cash flow considerations whenever you're selling a property or liquidating the partnership and shutting down operations. It's really important to understand how much everyone is going to be owed at the end of the day, because that ultimately tells you how much cash you get as the GP whenever you sell the property and liquidate the partnership. So it's really important to understand that.
And again, that emphasizes the risk GPs take in when they do these kinds of deals, right? Is that there's a chance that like everyone else gets paid and they don't. And that's something that's really, granted, maybe they got their cash through other ways, and that's why those acquisition fees, like a lot of times people complain about the number of fees that GPs charge, and maybe there's legitimacy to that, but simultaneously the GPs are taking on all this risk. There's a chance to get none of the depending on how the deal goes and how they take care of it themselves, they could get none of the upside at the end of the day, depending on how all this plays out ultimately. So it's definitely something to consider here. Matt, thank you always for talking through this situation with me. Thanks for your time as always, Matt, and we will see you guys next week on the Major League Real Estate Podcast.